Thank you all very much for joining us today. My name is Ilian Yotov. I am the author of The Quarters Theory, the revolutionary new foreign currencies trading method. I am assuming that a lot of the people who are joining us today were already at the webinar several weeks ago when I gave you the basic introduction to the Quarters Theory. So what we're going to do with the webinar today, we're going to build upon what I showed you a few weeks ago. So we're going to talk about a little bit more advanced concepts as far as the Quarters Theory methodology is concerned. Now, for those of you who are not familiar with my name, I am the founder of allthingsforex.com and tradertape.com, a couple of financial websites. Most of you probably are familiar with allthingsforex.com. I'm the host of a daily program there called the All Things Forex broadcast. So if you would like to go and listen to it, you can listen on fx3.com every day. The broadcast is posted every afternoon. It's a live analysis of major currencies, the current developments, news events, some trade ideas, etc. So take advantage of that. You can find it on allthingsforex.com or fx3.com every single day. The All Things Forex broadcast. And of course, you can always go to our website, www.allthingsforex.com. In the previous webinar, I showed you the foundation of the Quarters Theory. For those of you who are not familiar with it, let me just quickly remind you what the Quarters Theory is all about. What I do is I propose with the Quarters Theory that every significant price move occurs from one large quarter point targeting another large quarter point. What does that mean? Well, when we think in terms of pips or price interest points when it comes to currency exchange rates, for example, when I take a look at the major whole numbers, in a case of exchange rates, of course, most of these major whole numbers will be represented by a decimal point, so there will be decimal whole numbers. For example, in a euro-dollar exchange rate, if it were trading between $1.30 and $1.40, then those two major decimal whole numbers will give us a 1,000 pip range, or 10 cents in terms of pips, 1,000 pip range between $1.30 and $1.40. Between every two major whole numbers, as I like to call these, there is exactly 10 cents, or 10 yen, or 10 centimes, when it comes to certain currencies exchange rates. In a euro-dollar, for example, exchange rate, between $1.30 and $1.40, we have a 1,000 pip range. So in my Quarters Theory, what I do is I divide these 1,000 pip ranges into 4 equal parts, or 4 large quarters, as I call them, of 250 pips each. So this is a little example of the 4 large quarters within the 1,000 pip range between $1.30 and $1.40. The price points that give us the actual large quarters are going to be called large quarter points. So in my Quarters Theory, I propose that prices move in terms of quarters. And every significant price move when it comes to exchange rates occurs from one large quarter point targeting another large quarter point. So I basically challenge the notion that these price moves are erratic, that there's no organization in the price moves when it comes to how prices and price behavior actually develop on a daily basis. The daily fluctuations of currency exchange rates, according to the Quarters Theory, are occur in an organized manner from one large quarter point targeting another large quarter point, or if a large quarter point targeted is not reached, then another familiar price move occurs, which is a reversal that takes prices back to the preceding large quarter point. So you have these daily repetitions of these price moves that I basically propose occur in an organized manner when it comes to currency exchange rates. Between each two regular whole numbers, for example, $1.30 and $1.31, there is 1 cent difference. As many of you know, when you think in terms of pips, there you're going to have 1 cent equals 100 pips. So that 100 pip range is also divided by the quarter series into 4 equal parts, or 4 small quarters of 25 pips each. So here's the example where we can divide the 100 pip range between $1.30 to $1.31. You'll get 4 small quarters. So every significant price move I propose with the quarter theory occurs from one large quarter point targeting another large quarter point. But within each large quarter of 250 pips, there's also exactly 10 small quarters of 25 pips each. And as prices fluctuate between these small quarter points as well, they fluctuate in an organized manner in a constant, concerted effort for prices to complete the entire 250 pip range. Now today what we're going to do is we're going to talk about a very interesting concept that I also discussed in my quarters theory book, and that is the so-called 1,000 pip range transitions. See, when prices move from one large quarter point to another large quarter point, especially in recent several months when we have had such strong trends, especially when it comes to the euro weakening versus the US dollar, many of you would recall that the euro has fallen from several previous 1,000 pip ranges and has made several successful transitions into new 1,000 pip ranges. Now, this is a little bit of an example that I also gave you guys as far as completion of large quarters. If you recall, we were discussing large quarter completion and what it takes to complete a large quarter. I'm sorry about going fast over here, but I gave you in a previous webinar this example just to give you an idea of what the 1,000 pip range moves actually look like. And within that 1,000 pip range, how we have several completions of multiple large quarters. The example that I gave you here is the dollar versus the Japanese yen. And it shows you about 3 months from February until April of 2009. As we can see here in the beginning of the period, the major large quarter point at 90 yen is reached. Prices enter above the major large quarter point at 90 yen. They make a move towards the large quarter point above at 92.50 yen. However, on the first attempt, the large quarter there is not very successfully completed. We have prices pulling back to the preceding large quarter point. They don't break below 90 yen, and they make another attempt to complete the same large quarter, targeting the large quarter point at 92.50. Ultimately, on a second attempt, that large quarter is successfully completed. As you can see here in the circle, prices have reached 92.50 large quarter point. Then they break above the large quarter point at 92.50, make the first attempt, pull back to the preceding large quarter point, continue forward, and then complete another second large quarter of 1,000 pips to the major half point, as I like to call it. That is the exact half point of the 1,000 pip range between 90 and 100 yen. That will be the 95 yen level. Prices continue even forward, completing the next large quarter between 95 yen and 97.50 yen. As you can see, they even surpass above 97.50 large quarter point, pull back, don't break below 97.50, make another attempt, unsuccessful, pull back to the preceding large quarter point, third attempt to complete the large quarter. Finally, after 3 unsuccessful attempts, the final large quarter of the 1,000 pip range between 90 and 100 yen is not successfully completed. Prices pull back to the major half point of the 1,000 pip range, and then in the next several weeks, we have that quarter between 95 and 97.50 yen successfully completed, and then finally, even the large quarter between 97.50 and 100 yen is successfully completed. So what does that basically mean? That means that the dollar-yen exchange rate in those 3 months has not only managed to complete several large quarters of 250 pips each, but it has managed to complete the entire 1,000 pip range between 90 and 100 yen. Now, what happens here is obviously we see prices breaking above the 90 yen level. That is what I call a 1,000 pip range transition, where prices have at that point transitioned from the previous 1,000 pip range, which was the range between 80 and 90 yen, and have entered the new 1,000 pip range between 90 and 100 yen. Why did these transitions happen? Are they random events? Absolutely not. I explain in my book, The Quarters Theory, what the main reason for these 1,000 pip range transitions are. The market normally tends to price in things in advance, especially when it comes to the fundamental backdrop of certain currencies that are formed in that currency pair. For example, I wanted to bring you really quickly here the weekly chart, and let me know, guys, if you are able to see that, because I'm switching from the PowerPoint going to another screen. So let me know if I have to refresh things on my end. Are you able to see this euro dollar weekly chart? Okay, looks good. Excellent. Thank you very much. Here's, for example, the weekly chart of the euro dollar pair. Now, this is going to take us all the way back to the final month of 2009, which is, of course, December of 2009. Now, you would recall that even beyond here, the euro-dollar pair was trading within a range of 1,000 pip range between $1.50 and $1.60. If you recall, in November, wasn't it, or early December, euro-dollar pair was trading at $1.5140, if I'm not mistaken, was that the high for 2009. However, when the fundamental backdrop for the euro and the US dollar began to change, and the market quickly realized that obviously the current underlying fundamentals no longer, and exchange rate at that time no longer represented correctly the euro-dollar pair's exchange rate, meaning that at the $1.51, in light of the Dubai debt crisis, if you recall, which happened around Thanksgiving weekend in November, and that sort of started it all, when we started seeing massive risk aversion, when we started seeing the first days and weeks of the Greek debt crisis, which ultimately now has turned into the European Union debt crisis, and you know how that has gone. Since the final month of 2009, the euro has began to weaken. And what it has started to do at that point, the euro-dollar exchange rate has began transitioning into multiple, not only multiple large quarters, but also multiple 1,000 pip ranges. For example, you will see there in December, the euro-dollar pair has already fallen from the 1,000 pip range above $1.50, between $1.50 and $1.60, and has transitioned into a brand new 1,000 pip range between $1.40 and $1.50. Now, the market at that point realized that exchange rate between the euro-US dollar above $1.50 no longer represents the fundamental backdrop for the euro versus the US dollar. The euro was a very strong currency for the majority of 2009 as the market found the bottom and began to recover. They found the bottom in February, March of 2009. Until the end of the year, the euro managed to jump from $23.28 to $51.40 something, if I'm not mistaken. But ultimately, when things started changing, of course, with the Dubai debt crisis and then turning into the Greek debt crisis and the Eurozone debt crisis, we started seeing the euro-dollar currency pair giving us that phenomenon that I explained in my Quarters Theory book. And that's the 1,000 pip range transitions. Just to give you a quick example, you will see here that by the week of December 29th, the euro-dollar pair has already fallen to a low at $1.4257. Okay, many of traders who are not familiar with the quarters theory would probably think that that low at $1.4257 was a complete coincidence. To me, that is not a coincidence. When you think in terms of the methodologies of the quarters theory, $1.4250 is a very important price level there. If you're guessing that's a large quarter point, then you're absolutely right. $1.4257 is only 7/5 above the targeted large quarter point at $1.4250. As a matter of fact, because I'm getting an not an email, but rather a question. What is the euro doing right now? Let me just quickly show you. This is live data feed. Have you taken a look at the intraday low today? Follow me right here to the right-hand side of the screen where my cursor is. You will see that the intraday low for the euro-dollar pair today, after breaking below last night, below $1.2328, which was the low for the euro in 2008, after the massive risk aversion there, the targeted next logical price point that the euro-dollar currency pair has challenged was $1.2234. That is very close, only 16 pips below, as I call it, the 16 pips of an overshoot below the targeted large quarter point at the $1.2250. But let me go back to the 1,000 pip range transition. The quarter points, quickly to answer a question, the quarter points are not related to pivot levels. The quarter points and the large quarters, and that's the beauty of it, ladies and gentlemen, is that they never, ever change. They do not have to be calculated. In order for you to change the positioning of the large quarter points or the large quarters, you have to change math. So what is the beauty of that? These are constant, reliable price points and price ranges that give you an opportunity, gives the trader an opportunity to serve them as sort of a global positioning system. The beauty of it is that with the proposal of the quarters theory, which is the main premise of the quarters theory, that every significant price move occurs from one large quarter point targeting another large quarter point, then you know what the starting point is. And you also know what the end point of a significant price move could be. Now, not always, just because prices begin to work on a large quarter, that doesn't mean that the large quarter is going to be always successfully completed. Along the way, prices can exhaust, they can meet previous resistance levels that have been positioned there days, weeks, months ago, that have been strong resistance or support levels that could prevent the successful completion of a large quarter. But if a resistance or support is encountered along the way of the large quarter, then the next move is also familiar. As I also explained in my quarters theory, an unsuccessful completion of a large quarter is normally followed by a reversal move that takes prices back to the preceding large quarter point. And on a day-to-day basis, from now on, especially for those of you who are not familiar with my quarters theory, from now on, now that you are exposed to this, now that you know this, you will be able to monitor on a daily basis these repetitions of these price moves and patterns. And you're going to get more familiar with them, and you will see for yourself what I'm trying to explain to you now. Now let's go back to the 1,000 pip range. Here is the transition that's happening here into the 1,000 pip range between $1.40 and $1.50. Prices reach a support level at $1.4217. We got a little bit of a price correction. During the price correction, prices move. Take a look at the high there, $1.4556, which is approximately the half point, the major half point of the 1,000 pip range between $1.40 and $1.50. What happens after the correction is over with The euro-dollar pair continues its trend, and by only a couple of weeks later, we already have an intraday low there in the week of January 19th at the $1.4028. Okay, what does that mean? Prices have moved so significantly lower and have made further advancement into the 1,000 pip range below $1.50 that they have now almost completed the entire 1,000 pip range between $1.50 and $1.40. Now we know that every 1,000 pip range has exactly 4 large quarters of 250 pips each, right? So with the move to $1.40, we have completed 4 consecutive large quarters of 250 pips each. Not from right off the bat, of course. Not all of them were completed during that previous price move to the downside, which I also call, by the way, a bearish trend wave. I don't have the data all the way back there. But as you can see, another bearish trend wave begins here on the weekly chart of the euro-dollar pair, and not only has completed the 1,000 pip range between $1.50 and $1.40, but by the following week, the week of January 26th, you can already see lows below the $1.40 level. There's a low there at the $1.3852. What does that mean? That means that the prices, the market continues to price in further weakness of the euro versus the US dollar. And this is, again, think in terms of what's happening every day, every week. We get news and more concerns about that Greece could default. We get news that the crisis could continue to spread, et cetera, et cetera. So fundamentals are very rapidly changing, and the market continues to price in very rapidly this changing fundamental backdrop for the euro-dollar exchange rate, which no longer, even according to market expectations, it no longer even reflects $1.40 or exchange rate between the euro-dollar pair above $1.40 no longer reflects that fundamental backdrop. So the market at that point quickly decides that they should transition the the exchange rate of the euro-dollar pair into a brand new 1,000 pip range. What would be that new 1,000 pip range? Well, it would be the new 1,000 pip range between $1.30 and $1.40. Of course, if this is a negative trend, it's a downward trend, prices work that 1,000 pip range from top to bottom. So from the $1.40 level to the bottom of the 1,000 pip range towards $1.30. Now, in the next following several weeks, you will see that the major half point approximately of that 1,000 pip range between $1.30 and $1.40 is targeted. $1.3444 is an intraday low there, or a weekly low in the week of February 16th. Of course, after prices reach certain level, which is approximately the major half point of the 1,000 pip range, we get a little bit of a price correction. During the price correction, prices go to a high at the $1.3817. The euro-dollar pair finds resistance at that point, and we get another move lower. Guess where? To target the large quarter point of the $1.3250. Yet another large quarter. Keep in mind, we had already completed the 2 large quarters below $1.40 to $1.3750, and then from $1.3750 to $1.35. In order for prices to make further advancements into the new 1,000 pip range closer and closer to the $1.30 level, we're going to have to see a move to $1.3250 large quarter point, and then ultimately a move to $1.30 major large quarter point. Well, by the March 23rd, the week of March 23rd, the weekly low there at the $1.3267 is only 17 pips above the targeted large quarter point. And as I explained in our first webinar on the Forex theory, prices don't necessarily have to reach the targeted large quarter point exactly up to the pip. That would be almost impossible in a $3-4 trillion a day market in incredible volume. Prices cannot stop at a certain price point exactly up to the pip. In most instances, we're going to see them closer to that targeted large quarter point, but Sometimes you will see an exact large quarter point being reached as a high, low, open, or close for a particular time interval on your charts. But in most instances, you're going to see numbers that are either short, within a few pips short from the targeted large quarter point, or surpassing the large quarter point by a few pips. So realizing that prices cannot stop exactly at the targeted large quarter point, I designate the one small quarter area of 25 pips from a targeted large quarter point as the area that if prices reach within 25 pips or one small quarter from a targeted large quarter point, I consider the large quarter move as successfully finished and a large quarter as successfully completed. So that is the rule. With the low there at $1.3267, obviously prices are within 17 pips. They fall within that small quarter, 25 pips vicinity of the targeted large quarter point, and we get to see at that point that the large quarter below $1.35 to $1.3250 has been successfully completed. Just as I showed you earlier today, prices don't have to stop exactly at $1.2250. They have reached today $1.2234 as your intraday low. So they have overshot, they have surpassed the large quarter point targeted at the $1.2250. They have surpassed it by 16 pips, which is still considered as a successful completion of the large quarter. So after prices find support here at the $1.3267, they go through a period of a price correction for a few weeks, and then we quickly see them again dropping. And then, you know what happened a couple of weeks ago. We saw prices that fateful Thursday when the market panicked. The Dow dropped 1,000 points rather, not pips, in one day. The biggest one-day loss a couple of weeks ago on Thursday. We've had a very significant sell-off for the euro-dollar pair. And not only the euro-dollar pair at that point completed the 1,000 pip range between $1.40 and $1.30. But with that significant, huge drop for the euro versus the US dollar, you would remember that the euro reached a new low at $1.2506. That was in the week of May 4th, if you recall. What did that mean? Well, obviously, right off the bat, the euro-dollar pair has moved 500 pips almost below the major large quarter point at $1.30. In terms of large quarters of 250 pips each, that basically means that the euro-dollar pair in one trading session, because of the massive sell-off, has completed two large quarters of 250 pips each, below $1.30, targeted $1.30.2750, and below $1.2750, targeting the large quarter point at the $1.2506. Now, with that, prices are not going to stop exactly at the $1.2500. We shouldn't anticipate that to happen. But as you can also see, 6 pips above the targeted large quarter point is definitely a number within at least 25 pips vicinity. Close enough, of course, for us to consider that large quarter as successfully completed. In terms of 1,000 pip range transitions, the move to $1.25 also means a very important thing. As I explained in my book, The Quarters Theory, once prices move and complete the first large quarter of a new 1,000 pip range, then that is a sign that we might actually be witnessing a major shift. These 1,000 pip range transitions are what I call major shifts. They don't happen just because the market says, the heck with it, let's go ahead and transition the euro-dollar exchange rate. No. There has to be a strong enough fundamental reason as to why the market decides to transition exchange rates into these new 1,000 pip ranges. And of course, when it comes to the euro-dollar currency pair, there were strong enough fundamental reasons for these 1,000 pip range transitions to occur. So obviously at that point, with a massive move below $1.30, the market has decided that the euro-dollar exchange rate above $1.30, trading between $1.30 and $1.40 into the $1.30s, is no longer justified. And things have to be readjusted once again with another 1,000 pip range transition from the $1.30s into the $1.20s, which is the 1,000 pip range between $1.20 and $1.30. The decisive move that has not only completed the large quarter between $1.30 and $1.2750, but has moved prices even to the major half point, which is the exact half point of the new 1,000 pip range, towards $1.25, confirms that the 1,000 pip range transition for the euro-dollar exchange rate into the new 1,000 pip range is a decisive one, and it is obviously successful. Now, the major rule that I also follow when it comes to the successfulness or unsuccessfulness of the 1,000 pip ranges is I would like to see at least the first large quarter of 250 pips of a new 1,000 pip range to be successfully completed in order for me to consider this as a more decisive transition. In most instances, when you don't get to see a successful completion of a new large quarter of a new 1,000 pip range, you can see prices reversing back to the preceding large quarter point, and not only reversing back to the preceding large quarter point, but actually moving above it into the previous 1,000 pip range or below it, depending on the trend of the currency pair. But the euro-dollar pair, when it comes to these price pullbacks, never since reaching the half point at $1.25 on any pullback from that level, the euro-dollar pair never actually managed. And I'm going to switch us over to the daily chart so we can pay attention to these things on a more of a daily basis. Here is your $1.2506 low. Euro-dollar pair finds it. Then we have the announcement over the weekend of that massive $1 trillion bailout package proposed by the European Union. We get the euro jumping from $1.25, retracing to $1.30.93. It even overshoots above the large quarter point at $1.30. Goes as high as $1.30.93, but in the days after that, quickly falls below $1.30 level back into its new 1,000 pip range. It never stays within the previous 1,000 pip range. And that right there is a kind of a move. Ideally, I would prefer for prices to not even stay or even reach above the major large quarter point on a pullback. In this case, the package was so massive, and the euro went through some serious sell-off a few days before that the move above $1.30 caused prices to reach as high as $1.30.93. But as many of you have witnessed at that time, and that was not too long ago, you probably haven't forgotten about that move. It happened only 6 days ago or so, last Monday. Excuse me. So we have that move above $1.30, but immediately after that, prices have once again fallen to below $1.30. And once again, the euro-dollar pair begins to work on a large quarter below $1.30, potentially targeting the large quarter point at $1.2750. By the way, on this day, you're going to see that the intraday low for the euro-dollar pair, after falling below $1.30 from as high as $1.30.93, take a look at the intraday low. That was last Monday, May 10, $1.2758. But ladies and gentlemen, I'm sure that was just another coincidence. I'm joking, of course. This is the targeted large quarter point at $1.2750. Prices reaching within only 8 pips from the targeted large quarter point at $1.2750. Once again, completing the first large quarter of 250 pips of the new 1,000 pip range between $1.20 and $1.30. What's next? Well, obviously, on any pullbacks after that, if prices stay below $1.30, we can suspect that the market is ready to sustain the euro-dollar's exchange rate into the new 1,000 pip range between $1.20 and $1.30. And at that point, what we can also anticipate is that there may be further advances further into the new 1,000 pip range. Where to? Well, of course, to the previous lows around $1.25, which obviously was a logical price move, which we completed the move there to $1.25.17 just 3 days ago last week. Back to the major half point of the 1,000 pip range between $1.20 and $1.30. However, in the days after that, the very next day after that, the euro-dollar currency pair breaks below support at the $1.2506, which obviously is the major half point of the new 1,000 pip range. And then it moves even lower. Where to? $1.2328. Remember? That was the low for the euro-dollar pair in 2008. Major support level that is logical for the euro-dollar pair to challenge if prices were to break below the major half point and a large quarter point at the $1.25. And this is exactly the type of a move that we saw last Friday, with an intraday low for the euro-dollar pair at the $1.2353, which is only 15 pips or 25 pips at least above the targeted support level at the $1.2328. Over the weekend, as the market opened last night, $1.2328 support for the euro-dollar pair was broken. And as I mentioned earlier, surprise, surprise, I'm sure it was another coincidence, but prices moved to target the large quarter point at the $1.2250, overshooting it today by 16 pips below and reaching an intraday low today at the $1.2234. Now, as of today, we have the successful completion of yet another large quarter, the third large quarter of this new 1,000 pip range that we recently, last week, saw the euro-dollar exchange rate transitioning into, or the week before last week as well. And that was the transition below $1.30 from the $1.30s into the new 1,000 pip range of the $1.20s, between $1.20 and $1.30. Now, if you're a currency trader who is only concerned about where the next 10, 20 pips are going to come from, what I went through in the last, 45, 50 minutes, talking about 250 pips and 1,000 pip ranges, that probably is not very interesting to you. But if you're a trader, a currency trader who thinks in terms of bigger profits and more fluent, longer term type of moves, of course, one large quarter or two even could be completed in one trading session in a matter of hours. But in most instances, you're not going to see that. But when a trader, and hopefully what I have been able to teach you today is to expand at least your horizons. That there are much larger moves. And they're not random moves that occur on daily, weekly, monthly basis when it comes to currency exchange rates. Not only moves that can help you scalp the next 10, 20 pips, but moves that complete entire 1,000 pip ranges. Since the beginning of the year, the euro-dollar pair, as I gave you the example, has now completed almost to reach entire 1,000 pip ranges. From $1.50 to $1.40, from $1.40 to $1.30, and now most recently in the last couple of weeks, the three large quarters already of the 1,000 pip range between $1.30 and $1.20. And now we have the final large quarter of 250 pips ahead of us that the euro-dollar pair could work on. And that would be the large quarter below $1.2250, targeting the major large quarter point at the $1.25. There is a decisive break, almost 100 pips below $1.2328, which was the major support level from 2008. We're already seeing the large quarter point at the $1.2250 being overshot. That is not a decisive, however, move into the new large quarter below $1.2250. But that's what we're going to watch for in the days ahead. Will prices continue to make further headway after support is broken and targeting potentially the $1.20 level? Unfortunately, ladies and gentlemen, this is all the time that we have for today's webinar. I'd like to thank you very much for joining us today. And I'd like to thank the folks at fxstreet.com. If they organize another webinar, I would love to join you. If you would like to learn more about the quarters theory, as I mentioned earlier, you're always welcome. You're always welcome to come and visit me at allthingsforex.com and listen to my All Things Forex daily broadcast, Monday through Friday, 1 p.m. to 2 p.m. Eastern Time. With that, thank you all very much. Have a great afternoon and a happy trading. We'll see you soon.